This is Macro Horizons, episode 381, Julying Volatility, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of July 6th. As summer trading conditions take hold and the mercury rises, we're wary of the siren song of declining volatility in an environment of persistent uncertainty. What could possibly go wrong? Again. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market saw a return to trading the fundamentals with the backdrop of ongoing geopolitical uncertainty. It was a holiday-shortened week, and the price action was, to put it mildly, choppy. We have seen the ceasefire in the Middle East extend, and while there were some reports early in the week that hostilities were still ongoing, both sides have apparently agreed to continue to honor the ceasefire. Ship traffic through the Strait of Hormuz has continued to increase, albeit not back to the prior levels. Nonetheless, the energy sector has been remarkably well behaved, all things considered, with the front-month WTI contract trading near $70 a barrel. Not quite back to the pre-war zone, which was effectively $55 to $65 a barrel, but the conversations around the energy sector have shifted from whether or not the new floor will be $80 a barrel to whether or not we should be worried about a medium-term supply glut that will challenge the bottom of the prior range once traffic out of the Persian Gulf returns back to normal levels. It was also an interesting trading environment given the amount of volatility, albeit in-range volatility, that was seen throughout the week. Now, this is very consistent with the time of the year that the market is entering. Typically, as summer vacations increase, attendance decreases, and conviction remains muted. These are precisely the type of trading dynamics that we expect will define the next several weeks in the U.S. rates market. After all, the summer doldrums are quickly approaching on the horizon, and the monetary policy outlook remains stable in the near term, but unclear as we get to the September meeting or beyond. The economic data continues to make the case for patience, and in light of the outright level of U.S. yields at the moment, the equity market has continued to perform well overall, and it's worth highlighting that we'll soon be entering earnings season, which will provide yet another litmus test for current valuations in U.S. stocks. If the recent price action is any indication, however, it will be difficult for the market to view any pullback in risk assets as anything other than a dip buying opportunity, given the fact that all of the prevailing uncertainties on the geopolitical side have failed to trigger a durable bearish repricing in U.S. stocks.
So taking a step back, many of the broader uncertainties and underlying assumptions about the state of the U.S. economy and what it ultimately means for the outright level of Treasury yields, the shape of the curve, and how the Fed under new management is going to respond to incoming developments remain intact. We have a moderating, although still unacceptably high, inflation environment that Warsh has acknowledged the Fed will act to fight, and we also have a labor market that is still in a, at least, decent spot. This past week's JOLTS numbers showed an upside surprise in labor demand, and the aggregate of the data that we've seen over the first 6 months of 2026 has hardly showed an economy that is responding in a materially negative way to the current level of policy rates. Now that begs the question, is monetary policy actually restrictive at these levels? Is there some more material shift underway in terms of the structure of the economy, either in the post-COVID framework or in the AI framework, that means a broader rethink of the construction of monetary policy is appropriate? At the end of the day, the biggest question for investors is that now that we've seen the situation in the Persian Gulf at least resolved enough to get ships moving again through the Strait of Hormuz and crude oil prices back to more or less pre-war normal levels, how has the evolution of the economy over the first 2 quarters of this year played into the Fed and Warsh's decision-making about the appropriate next steps, both for Fed funds and for the balance sheet? A July hike, while not our base case, is certainly being discussed, and the broader consensus is that either in September, October, or December, we will see at a minimum a fine-tuning policy rate adjustment, if not the start of a series of rate hikes that peaks sometime in the early part of 2027. At least, that's what the front end is saying.
And it's an interesting dynamic to contemplate because the Fed tends not to move in one-off quarter-point increments. Certainly not as they were lowering policy rates, where 3 rate cuts appears to be the norm. On the way up, will that be the same dynamic? We certainly struggle to envision a scenario where they only increase policy rates by 125 basis point increment. So that implies that if they do hike, they'll at least deliver 2 hikes, if not 3 or 4. So presumably, among the FOMC members, the bar to tighten policy rates by an implied 75 or 100 basis points should be pretty high. Said differently, a directional shift in policy rates implies a degree of follow-through with future rate hikes that the market will surely be pricing in. Even as it stands, we're currently pricing in a full rate hike plus some by the end of the year, and we have no clear confirmation that that's the direction that Warsh is going to take policy rates in the near term. What the debate then becomes is whether or not the committee is comfortable hinting at rate hikes but not ultimately delivering, effectively convincing the market to do a bit of the heavy lifting for the Fed, i.e. front-end yields increase, there's a positive implied probability of a rate hike over the course of the next several meetings, and yet the Fed doesn't ultimately follow through. Now, clearly, this strategy would need the justification of inaction in the form of a softer data profile at some point, but certainly not in the very near term. Instead, what we find is an environment in which there has been less, not more, official communication from monetary policymakers, which then complicates the process of determining the Fed's reaction function to the evolution of the realized data. Now, this was always going to be the case when Warsh made the decision to begin scaling back information flow from the Fed. There will be some recency bias insofar as investors believe in general terms that they understand how the Fed will respond to a spike in the unemployment rate or a spike in core CPI or core PCE. But the further away we are from a Powell Fed and the less clear direction that is coming out of the Warsh Fed, the more complicated the calculus becomes. As a result, we're left to contemplate a scenario in which immediately before a particular meeting, whether that meeting is July or September, the market is either fully pricing in, i.e. 80% or higher probability of a rate hike, or fully pricing out, i.e. 20% or lower of a rate hike, and the Fed surprises in either direction. In the past, such an outcome was unlikely because monetary policymakers would lay the groundwork for what the market should expect from a given Fed meeting well in advance, presumably even in advance of the Fed's pre-FOMC meeting period of radio silence. Recall that there were a few episodes in which a game-changing data point, such as CPI, came out during that period of radio silence. And in such a scenario, the Fed was comfortable using the financial media to message to the market how they were interpreting the data and what that then subsequently meant for the upcoming policy decision. Assuming that Warsh is no longer comfortable providing the amount of guidance and information ahead of each specific meeting, it then follows intuitively that investors face a higher surprise or disappointment potential.
And that surprise or disappointment potential in some ways delivers a tightening impulse in and of itself. by introducing a bit more short-term volatility to the outlook for overnight rates, to say nothing of the potential mechanics of actually increasing funding market volatility via future changes to the balance sheet. What Warsh is doing is delivering a tightening impulse to financial conditions without actually needing to raise overnight rates. Obviously, the most material change that we saw at the June FOMC decision was the shift in the structure of the statement itself, which was dramatically reduced, offered a far less specific characterization of the committee's interpretation of the economy, and removed the easing bias along with the clarification of who dissented and who didn't, even though in this case it was a unanimous decision. What this will do, along with what we're expecting is going to be a material shift lower in the frequency of Fed speak that we receive over the medium term, will make rate hike pricing far more a function of the incoming data itself. And in one of the more significant aspects of the shift from the Powell Fed to the Warsh one, we likely won't be going into every single FOMC meeting with an extremely clear expectation about what's actually going to happen to Fed funds. And so that tail risk 20% that you mentioned, Ian, is going to inherently introduce a bit more volatility and a bit more skepticism around the backbone of the fixed income market, which is overnight rates. And so, by gradually introducing that level of volatility to the market, Warsh is hoping to push financial conditions tighter, which will have a cooling impulse on inflation and hopefully not too dramatic an impact on the labor market.
And frankly, hopefully it also won't have too dramatic of an impact on the equity market. Given the ongoing outperformance of equities, just broadly speaking, the relevance of the wealth effect is difficult to overstate. We know that the top 10% of consumers drive roughly 50% of spending in the U.S., and as long as equity valuations remain at lofty-ish levels, then one should assume that there will be a cushion in the event of any deterioration of overall labor market conditions. And as a result, this could reinforce the remarkable resilience that's been demonstrated by the U.S. economy over the course of the last several quarters. It's also worth highlighting that if we were to back out the AI build-out, or at least the non-residential fixed investment, GDP growth would be materially lower. In fact, of the 2.1% real GDP expanded in Q1 on a quarterly annualized basis, 1.4% of that was a function of the AI build-out. The AI build-out has further complicated the Fed's decision-making because it appears that, at least in the near term, it has created an inflationary impulse in the form of memory chips. This has been messaged from manufacturers of consumer goods and leaves the market to consider how much this impulse could prevent what might otherwise have been a moderating core inflation trend over the balance of this year from coming to fruition. We, as a market, were already concerned about the potential pass-through of elevated energy costs over the course of the last several months into core goods and core service prices, and by introducing the AI build-out wildcard into the inflationary landscape, we'll argue that the resulting dynamic is one that bodes very well for Fed inaction between now and the end of the year, as opposed to kicking off what would be a several rate hike campaign.
And there is some reason for optimism that all of what we're discussing and the emphasis on tighter financial conditions may not come at the expense of equity valuations or spread products and trigger a broader wealth effect-driven rethink around the state of consumption. And the cause for optimism there is that during the post-pandemic period, and given the massive amount of liquidity that was injected into the system, there is still no shortage of capital in the financial system that is in need of a place to be invested. One of the most consistent themes we've heard from clients of all types, whether that's buyers of treasuries, corporate bonds, mortgages, is that they have to buy something. And so by needing to buy something, given the amount of capital that needs to be invested, that will inherently offer a supporting bid to duration, to spreads, and further out the risk curve to equities. And while that won't necessarily prevent periods of softness and episodes of pullback, it likely means that any material drawdown in risk asset valuations will ultimately be seen as an opportunity to deploy cash at more attractive valuations. And while the realities of the K-shaped recovery fit well into this narrative and the fact that not every income quartile's exposure to financial assets is created equal, will mean that the question will once again be brought up on the FOMC: is the Fed setting monetary policy for the upper part of the K or the lower part of the K? And if the current stance of policy is restrictive for one of those groups but not the other, how will Warsh respond to that? Especially as we wait to learn more about the task forces that Warsh is creating and what their findings will ultimately be, we anticipate that that dynamic and the relationship between financial asset inflation and core goods and services inflation will be an instrumental variable in determining how Warsh wants to communicate his vision for the Fed's monetary policy framework over the medium to longer term.
Alas, as Warsh has noted, the results of these task forces will not be available for at least several months, if not quarters.
Lagged and variable. I'm sensing a theme here.
That makes one of us. In the week ahead, the Treasury market will have very little on the calendar from an economic data perspective to derive trading direction. In fact, as we enter the first full week of July, we expect that price action will be choppy and that the emphasis will remain on any developments in the Middle East and their ramifications for the energy sector and therefore forward inflation expectations. On the supply side, we have a $58 billion 3-year auction on Tuesday afternoon, followed by $39 billion 10 years on Wednesday, capped by $22 billion 30 years on Thursday. As a theme, the Treasury auctions have continued to meet solid reception, and given the outright level of rates at the moment, we don't anticipate any material issues underwriting the incoming supply. Even as such, we do expect that there will be some type of supply concession, whether that is in outright yield levels or on the curve. If for no other reason, then supply is the primary known event of the week ahead. To be fair, we also see the FOMC minutes from the June meeting, which should be interesting given the changes seen to the Fed statement. Recall that the length of the statement was roughly cut in half versus the most recent statements under Powell. Warsh also outlined the 5 task forces that he's put in place to evaluate some of the key potential changes that he would like to make at the Fed. And it will be interesting to see the response of other committee members from some of the changes that Warsh appears to be championing at the moment. Now, while we're somewhat skeptical that the FOMC minutes will be a tradable event per se, it should be on the radar, if for no other reason, then it will give us context for how Warsh's first meeting as the chair of the FOMC transpired and any pushback that he might have received behind closed doors. In keeping with the theme from the June meeting of less is more on the communication side, it will be notable the degree to which the incoming FOMC minutes matched the length and the detail of prior minutes. There are clearly parallels to be drawn between shortening the statement and providing less information via the FOMC minutes. Historically, the FOMC minutes have encapsulated both sides of any debate on the committee, and while we suspect that this will remain the case, the amount of detail remains the wild card. On the data front, we do have Monday's release of ISM services, although we'll argue that the broader tone in the Treasury market has already been set, and it will be more of an issue of waiting until the following week's release of the core inflation series. Recall that on the 14th of July, we see core CPI followed by core PPI on Wednesday, and then Friday of that week, we see import prices. And that should set the market up well for core PCE estimates for the month of June. It will also be a key contributor to investors' expectations for the July FOMC meeting. If nothing else, the Fed's next meeting is shaping up to be a litmus test for Warsh's commitment to consolidating and limiting forward guidance. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And for everyone who has been eagerly awaiting the opportunity to vote in the Extel Global Fixed Income Research Poll, great news! The vote will be live on Monday, July 6th. We would truly appreciate your support with 5 stars in our key categories of U.S. rates, technicals, fixed income, and short duration. Thank you for your support. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.